It's funny. When you see a really bad car accident on the side of the highway,
Oh, yeah.
and, well, everyone is safe, thankfully, but the car itself is just entirely crumpled.
Completely totaled.
Right. The hood is folded in half, the windshield is shattered, the airbags are deployed, the insurance adjuster comes out, they take a look at the math, and they just declare it a total loss.
Because repairing it would cost way more than the car is actually worth.
Exactly. And for you, the driver, the story pretty much ends right there. You get a check, you go car shopping, and that mangled sedan gets towed away.
It just vanishes from your life, you know? The problem is solved and the wreckage is out of sight.
But there is no magical place called away.
Right.
That crumpled piece of steel, leaking oil and shattered glass, is actually entering a highly orchestrated, incredibly lucrative global machinery. And today, we are going to look under the hood of that exact machinery.
I love this topic. It is the perfect example of a hidden economy sitting right in plain sight.
It really is. So welcome to today's deep dive. We have a topic tailored specifically for your curiosity today. We are taking a dense, kind of number-heavy financial document and translating it into a fascinating story about a quiet global empire.
We pass by the physical infrastructure of this industry all the time, often without even realizing it.
Totally. Our source material today is the official Copart, Inc. Q3 Fiscal 2026 earnings press release, along with the accompanying financial tables, and this covers the period ending April 30th, 2026.
Yep, fresh numbers.
So our mission today, to decode how a business focused entirely on used, wrecked, and salvaged vehicles manages to sit on an absolute mountain of cash.
Because this is a company that doesn't manufacture a single car.
Not one.
They don't sell new vehicles, yet they offer a masterclass in logistics, matchmaking, and profitability.
Yeah, and what is most compelling about these numbers, I think, is that they prove a fundamental business truth.
Which is?
Well, the less glamorous a business appears on the surface, often the more robust its financials actually are.
Oh, absolutely. I mean, people love to analyze tech startups, artificial intelligence, or luxury brands.
Right, the flashy stuff.
Exactly. But the real financial fortresses, the ones generating massive, predictable cash flow, are often built on things like salvaged auto parts, muddy lots, and chain-link fences.
So true. So let's establish the sheer scale of this invisible empire before we get lost in the billions of dollars.
Good idea.
Copart was founded back in 1982, and today they are a global leader in online vehicle auctions. And when I say global, I mean it.
They are everywhere.
They connect vehicle consigners, so we were talking about your insurance companies, rental car fleets, financial institutions, even charities, with approximately 1 million members across over 185 countries.
But, the word online in their description is doing a lot of heavy lifting there.
How do you mean?
Well, we have to ground this in the physical reality behind the digital interface. They sold over 4 million units in the last year alone.
I really want to pause on that. 4 million physical cars.
It's hard to even picture.
Right. To make that real for you listening, imagine a flooded 2022 Ford F-150 in Houston, Texas. A hurricane rolls through, the truck is submerged, and the insurance company writes it off.
Yeah, because that insurance company doesn't want to be in the business of selling wet trucks.
Exactly. It is just a liability taking up space. So Copart steps in, they take the truck, catalog it, and list it on their digital auction block.
And this is where the magic of their network effect comes into play.
Break that down for us.
Well, before digital auctions, that flooded truck would just sit at a local Texas salvage yard, basically hoping a local mechanic or parts dismantler might wander in and want it.
Right, a very localized, tiny market.
Exactly. Copart takes that localized, inefficient market and makes it global. Now, a specialized engine rebuilder in Omaha or a part supplier in Oman can log on, see the high-resolution photos of that exact F-150, and bid on it in real time.
Wow.
Yeah, they provide liquidity to a totally illiquid market.
They literally find the one person on Earth who values that exact chassis or those salvageable parts the most. And the numbers they are generating from this global matchmaking service are just staggering. Let's look at the top line for the third quarter of fiscal 2026.
Let's do it.
Their revenue hit $1.2 billion. That is a 2.1% increase from the exact same period last year.
A massive quarter.
Yeah, and their fully diluted earnings per share was 43 cents, which is up 2.4%.
And for anyone who gets tripped up by the phrase fully diluted earnings per share, think of it this way.
Yeah, please explain that one.
So if you take the company's total profit and divide it by every single possible share of stock that could exist, including stock options that employees haven't even cashed in yet, Every single slice of that pie earned 43 cents over those 3 months.
So it's basically the most conservative, honest way to measure a company's profitability per share.
Exactly. And it is growing, over $1 billion in a single quarter, purely from facilitating the movement of used and damaged vehicles.
It rarely is a straight line to the bottom, though, especially here. Let's actually look at the friction eating into that top line.
Because there is a lot of friction.
Yeah, when you start digging into the margins, a really curious contradiction emerges in this report. You see this rising revenue, but it's not translating perfectly down the page.
The top line shows us the volume of money coming in, but the bottom line shows us the reality of what it costs to process that volume.
Right. So for Q3, their gross profit went up 3.7%, landing at $572.6 million.
Damn,
Great on
it's so
paper.
very healthy.
But then you look at the net income attributable to Copart, the actual money they get to keep after everything is paid, and it decreased by 1.0%, down to $402.4 million.
And if we pull back the lens and look at the 9-month snapshot ending on that same date of April 30, the story twists again.
How so?
Well, over those 9 months, total revenue actually decreased slightly by 0.2% to $3.5 billion, yet the 9-month net income saw a tiny microscopic increase of 0.1%.
Okay, so let's unpack this mechanism.
Yeah.
I'm looking at the operating expenses here, and general and administrative expenses jumped 7.2% to $93.7 million. But the really glaring number is the facility depreciation and amortization, which rose 8.0% to $51.9 million.
That is the physical cost of doing business.
Right. My first instinct here is that this is simply the expensive reality of keeping the lights on at 250 massive physical lots. We think of them as an online auction, but moving 4 million mangled cars is essentially an incredibly heavy, dirty logistics operation.
That physical footprint is the defining characteristic of their expense sheet.
It has to be.
Yeah. If you are listening to this and wondering why on earth a company would spend $450.3 million in a single quarter just on facility operations, you have to remember the physics of this business.
You cannot download a totaled sedan.
Exactly. You have to park it somewhere.
And you can't just park it in a random field.
No, absolutely not, because wrecked cars leak. They leak motor oil, transmission fluid, battery acid, and coolant.
Environmental hazards everywhere.
Yes. You are dealing with strict environmental compliance. Land needs to be paved, fenced, secured, monitored, and staffed.
So that explains the costs.
And you mentioned depreciation rising by 8% earlier. In accounting terms, depreciation sounds abstract, but in the physical world, it is the literal wearing down of the business.
Like the actual physical wear and tear.
Right. Asphalt degrades under the weight of thousands of heavy tow trucks. Forklifts break down. Chain-link fences need replacing.
It is the ultimate contrast to a software company, isn't it? A tech company can onboard 1 million new users, and all they have to do is spin up a few more cloud servers.
Which costs next to nothing.
Right. The cost is negligible. But for Copart, every new car they take in requires a physical square footage of dirt or concrete. As they grow, the sheer gravity of maintaining that physical footprint naturally weighs on the margins.
Which brings us to the strategic puzzle management has to solve.
And what's that?
How do you maintain growth when your primary market requires so much physical overhead and that overhead is getting more expensive to maintain?
You have to look at where the growth is actually coming from.
Exactly. And whether you can find cheaper dirt or untapped markets.
Well, if expanding physical lots in the U.S. is getting too expensive because of that friction we just talked about, it forces a company to look outward. Is that why we're seeing this sudden surge in their international numbers?
That is exactly what is happening.
Because when you look at the segment's information table, it reveals a tale of two entirely different markets, the U.S. versus international.
The contrast in those two segments really tells the story of their next decade.
Yeah. In the U.S., which has obviously been their home base for over 40 years, the service revenues for Q3 actually dropped. Not by a ton, but they fell from $898.6 million in 2025 down to $895.4 million in 2026.
We are seeing a slight contraction in their biggest, most established market.
But then you look across the border and across the oceans. International service revenues jumped significantly.
Big jump.
They went from $136.2 million in 2025 all the way up to $160.6 million in 2026. And this isn't just one or two neighboring countries either.
No, it's a massive footprint.
The report lists their current international operations. Canada, the United Kingdom, Brazil, the Republic of Ireland, Germany, Finland, the United Arab Emirates, Oman, Bahrain, and Spain.
And the dynamic at play here is market maturity.
How so?
Well, the U.S. market for salvaged vehicles is highly developed and heavily saturated. Copart already holds a massive market share here.
They're the big fish.
Right. And when you are the dominant player in a mature market, squeezing out an extra 5% of growth becomes incredibly difficult. You are fighting your competitors over inches.
Because there are only so many cars getting totaled in the U.S. in any given quarter.
Exactly.
Unless there is a sudden spike in accidents or a massive natural disaster like a hurricane flooding a city, the inventory pool of wrecked cars is somewhat fixed by the population and their driving habits.
You can't magically invent more totaled vehicles just to hit a quarterly earnings target.
Right. So to maintain momentum, Copart is aggressively building an overseas footprint.
Yeah, by taking their proven technology platform and their operational playbook into countries like Brazil, Germany, or the UAE, they are capturing market share in regions where the organized digital salvage auction model is still in its earlier stages of adoption.
But wait, taking a software platform overseas is one thing. Building a massive heavy machinery logistics network in 11 different countries sounds like a bureaucratic nightmare.
Oh, it is.
I mean, you have to navigate the local towing laws, the real estate zoning for industrial salvage lots, and the environmental regulations of the European Union versus the UAE.
It's extremely complicated.
So is this international market actually big enough to move the needle for them long term? Or is it just a distraction from their stalling U.S. engine?
It is a massive operational hurdle. You are absolutely right about the local regulations, but it is entirely necessary.
You think so?
Definitely. The international segment is smaller in absolute dollars right now, 160 million compared to the US's 895 million, but its growth rate is doing the heavy lifting.
It is offsetting the stabilization happening in the U.S.
Exactly. By planting their flag in these countries now, they are trying to secure the same near monopoly status abroad that they enjoy at home.
Okay, so they have this mature cash cow operation in the U.S.
Yeah.
and this rapidly growing high investment operation internationally.
Hmm.
We've seen how they make their money, the physical friction of their operating costs, and where their growth is coming from.
Yeah.
Now, we arrive at the part of this financial statement that requires a serious double take.
Oh, the balance sheet and the cash flow statements.
Yes.
This is where the story shifts from operations to capital allocation.
Basically what Copart is doing with the immense pile of cash they're generating. Let's look at the balance sheet highlights for a second.
Okay.
As of April 30, 2026, they are sitting on $3.35 billion in cash equivalents, and restricted cash.
And I want to clarify restricted cash for a moment.
Sure, what is that?
That is money they physically hold but cannot use for daily operations because it is legally earmarked for something else.
Like what?
Often things like escrow payments or specific regulatory deposits required in those 11 different countries we just talked about.
No, okay, that makes sense.
But even factoring that in, the total cash pile is staggering. In July of 2025, that number was $2.78 billion. So they've added over $500 million in cash to the pile in under a year.
$3.35 billion just sitting there.
Yeah.
That is wild. They have total assets of $9.64 billion. They also have retained earnings of $7.65 billion.
A huge war chest.
Yeah. And for anyone not swimming in accounting terms, daily retained earnings is essentially the corporate equivalent of a massive savings account.
Right.
It is the cumulative total of all the profits they've made over decades that they haven't paid out to shareholders as dividends. They just keep rolling it over, building this fortress.
It is a testament to the fact that their core business of auctioning scrap metal generates far more cash than it takes to actually run the day-to-day operations.
But here is the part where I have to push back on their strategy a little bit.
Let's hear it.
When you look at the consolidated statements of cash flows under financing activities, there is a line item for the repurchases of common stock.
The buybacks.
Over the 9 months ended April 30, Copart repurchased a staggering $1.63 billion of their own stock. And just for context, if you look at the column right next to it, for the exact same 9-month period in 2025, the amount they spent on stock repurchases was zero.
Quite the deal.
$0, up to $1.63 billion in 9 months.
And that was fueled by an operating cash flow for those 9 months that was a highly healthy $1.24 billion.
But see, I look at that $1.63 billion buyback, and part of me thinks this is actually a red flag.
Really? Why is that?
Well, if you have over $3 billion in cash, shouldn't you be innovating? Shouldn't you be acquiring competitors in Brazil or Germany instead of just buying your own stock?
It's a fair question.
When a company does this, it feels like they are just artificially inflating their own stock price
Hmm.
because they ran out of ideas. Defend this move for me. Why is management doing this instead of expanding the business?
It is a great challenge, and it goes right to the heart of how capital efficiency works.
Okay, convince me.
Let's break down the mechanics of a stock buyback first. Imagine a company as a pizza cut into 100 slices.
Sure.
If you own one slice, you own 1% of the company's future profits. When Copart spends $1.6 billion to buy back its own stock, it takes those slices off the table and destroys them.
So now there are fewer slices.
Right, now the pizza is only cut into 90 slices. Your single slice just got bigger, meaning your share of the company's future profits just increased, without you having to do a thing.
So it is a direct way of returning value to the shareholders without paying a taxable dividend.
Yes,
Yeah.
exactly. But to address your red flag, why not build more lots or buy competitors? Management is essentially signaling that they have hit the ceiling of productive reinvestment.
Meaning they literally can't spend it fast enough on the actual business.
Look at their investing activities. They still spent $258.5 million on property and equipment over those 9 months. They are still feeding the machine, paving lots, and buying tow trucks.
Okay, so they aren't starving the core business to fund this buyback.
Precisely. But even after fully funding their international expansion and maintaining 250 massive lots, the cash is piling up faster than they can reasonably deploy it.
That is a crazy problem to have.
Yeah, and if they tried to force that $1.6 billion into new foreign markets too quickly, they might make reckless acquisitions, overpay for land, or expand into regions where the salvage laws don't favor their model.
Oh, I see.
By buying back their own stock, they are saying, we believe our own established business is the safest, highest-yielding asset we can buy right now. It signals supreme confidence that their cash-generating fortress is built to last.
A cash-generating fortress built entirely on wrecked sedans, localized disasters, and salvaged parts. It really changes the way you look at the physical world around you.
It really does.
So what does this all mean for you listening right now?
I think the biggest takeaway from this deep dive is a masterclass in finding a specific, totally unglamorous niche and dominating it completely.
100%. Copart isn't building artificial intelligence. They aren't launching rockets. They're managing the logistical headache of totaled cars. But by applying an incredibly efficient digital auction platform to a fundamentally dirty physical world, they have built a multi-billion-dollar global engine.
It is brilliant, honestly.
The next time you see a wrecked car on the back of a flatbed tow truck, you won't just see twisted metal. You now understand the highly profitable billion-dollar global machinery waiting to catalog it, park it on a heavily regulated lot, and auction it off to the highest bidder anywhere in the world.
It is the ultimate lesson in the hidden value of operational efficiency. They have essentially figured out how to consistently monetize the aftermath of bad luck.
And as we wrap up, I want to leave you with a final forward-looking thought to mull over, something we didn't explicitly see in the quarterly numbers today, but which feels entirely relevant to this company's future.
What's that?
The report constantly reminds us of their massive physical infrastructure, over 250 locations worldwide. But the automotive world is fundamentally changing.
Oh, the EV shift.
Right. As we transition from internal combustion engines to complex electric vehicles, the very nature of what a wrecked car is changes entirely.
The risk profile shifts dramatically.
Exactly. When a gas-powered car gets rear-ended, you tow it, drain the fluids, and park it in a dirt lot. But electric vehicles, when severely damaged, are notoriously difficult and highly dangerous to store.
Yeah, a compromised lithium-ion battery has severe risks of thermal runaway.
Which means it can spontaneously catch fire days or even weeks after the initial accident.
And those fires are incredibly difficult to extinguish. You can't just throw water on them.
Right. It forces a massive paradigm shift for their physical operations. You can't just stack total EVs next to each other in a standard chain link lot.
No, if one goes up, they all go up.
So how will a company that is so deeply invested in the physical real estate of salvage lots have to adapt its entire infrastructure? Will they need to invest billions into specialized fire suppression bunkers?
Or maybe they'll have to buy double the amount of land just to space the cars further apart.
Exactly. It makes you wonder how the transition to electric vehicles will reshape the physical footprint and potentially eat into the margins of this invisible empire in the decades to come.
It is a structural challenge that every single player in the physical automotive space is going to have to reckon with.
It definitely is. Thank you for joining us on this deep dive into the hidden world of salvage auctions. Keep your curiosity sharp and we will see you next time.